Welcome to Something More with Chris Boyd. Chris Boyd is a certified financial planner practitioner and senior vice president and financial advisor at Wealth Enhancement Group, one of the nation's largest registered investment advisors. We call it Something More because we'd like to talk not only about those important dollar and cents issues, but also the quality of life issues that make the money matters matter. Here he is, your fulfillment facilitator, your partner in prosperity, advising clients on Cape Cod and across the country. Here's your host, J. Christopher Boyd.
Welcome. This is Something More with Chris Boyd. I'm Chris Boyd here with Jeff Perry and Russ Ball. Thanks for being with us. And we have an interesting topic to get into in just a moment. But before we do, wanted to start off, Jeff, we were just talking about National Financial Awareness, right?
Yep, we're recording on August 14th, and today is actually National Financial Awareness Day. So be aware of your finances today and every day.
That's right. And we wanted to mention that if you have any kind of digital footprint, you might be interested in a webinar we have coming up that will help you in your financial awareness as well. You can give the details. It's September 9th. Don't leave a digital mess.
Yep, the title is Don't Leave a Digital Mess, How to Prepare for the Inevitable, which means you're
all going to pass it.
We're all going to pass away. In today's high-tech world, it is Tuesday, September 9th, from 10:30 to 11:30. We have an expert guest coming on, and it is one of those things that, I don't know if I'm prepared.
I'm sure the same. Yeah,
right?
There's things I need to do still.
I've done things to prepare for my untimely departure from this earth, which,
What are the kind of things that come to mind, Jeff, for you when you think about this topic, for things you've done or may need to do yet?
So it more comes to mind. So Lisa and my wife and I, we're pretty much on the same page on everything. She knows I pay the bills, but she knows how. I've given her, instructions, if you will, we've talked about it. And but sometimes you have a tragedy. Sadly, we see this, that both people, husband and wife, pass, in an accident or something, and I have no idea how anyone would know, in my family or the people I have named as trustees, successor trustees or executives. I don't know how they would know anything. They certainly, it's not like I give my backup trustees, backup executives, all my passwords to everything.
Yeah, it's a great point. Just when you think about over the years, all the pictures you've stored on Facebook,
and there's that, right? Yeah.
Have you ever gone on and be like, didn't they die 4 years ago? And people are wishing them a happy birthday.
I know. Yeah, that's tough.
And who gets access? I don't even know if I know the password to my Facebook anymore. It's it's remembered, you know what I mean?
Right.
But that's an example of a digital asset that you need to think about. How do you plan for that? Now, if Facebook, for example, or a company like that, a social media company, identifies that you've passed, they may just shut down that page, and all those resources could be lost unless you've taken the right steps. Maybe you have an Amazon account with Amazon Prime, or and there are things that you've bought, movies, for example, on the video service, or maybe you have music that you've purchased as opposed to a subscription service, or maybe you have books that you've acquired through Audible or like a Kindle or something. These are all examples. These are not huge examples, but they're examples of things those are things you've paid for, and you could lose if there's no plan for it. It won't go on. A bigger example might be cryptocurrency, digital currency.
Sure.
If you didn't have a game plan for how does that key, that wallet, that digital wallet get transitioned to someone else. There are all kinds of examples that we take for granted, let alone access to my bank and the auto pay that comes with that. What happens if that's in one name, not both names? Well, in any case, we've got a whole laundry list of things that Kate is going to go over. and it's an incredibly good talk. Anyway, we don't want to give all the content, but just as a teaser, September 9th, we're going to record the program, but if you're able to join, you can ask questions and participate. What time was it again scheduled for September 9th?
10:30. We're on Eastern time.
And you can register in advance. You can register right now. We'll put a link in the show notes for that.
Absolutely. Yeah, we're only discussing the things that we're thinking of, and we didn't offer any solutions. So tune in for the solution part.
Yeah. Well, yeah. So tune in. It's a great program, and there's a lot of great information that you're going to learn. So with that being said, what we really want to talk about today, though, is a different topic entirely. And let's get into that because, Russ, you can set this up because you actually brought up the topic as one that might be one for consideration. There's been some press around this lately, and maybe one for a little bit of discussion amongst us.
Yeah. So I've been seeing a lot of articles recently about this new change to 401k plans that the president is not exactly sure of the process of how that gets permitted, but in any case, 401ks are being opened up to private equity, private credit, alternative assets.
At least this is the proposal.
At least
right?
This is the proposal.
No, it's happening. It was an executive order signed by the president directing the Department of Labor to institute rules. So it's an executive order. We believe he has the authority to do this.
Yeah. All right, let's talk about it for a minute. You hit on a variety of generally considered to be somewhat illiquid assets, private equity, private debt, real estate, and digital assets like cryptocurrency, Bitcoin. Let's start with, is this a good idea?
Or maybe what could go wrong? Right?
What could go wrong? Yeah. Well, traditionally, I mean, I think there are currently some challenges that are faced with doing this because there's a fiduciary expectation in whether or not this is in the best interest of employees to have access to some of these kinds of investments. I think it's really important, maybe perhaps how they put safeguards around this to determine whether this is a good idea or not. Go ahead.
I'm gonna say you hit the nail on the head with that. I mean, most of the process, the internal process with 401ks has to do with the companies following the rules about their fiduciary responsibility to the plan and to their employees, right? And so that's the first thing I thought of anyway. And by saying, okay, I'm just going to pick on cryptocurrency because people know what it is. They might not know what private credit is, right?
Yeah.
To say you can put part or all, we'll see if they put a limit on it, right? The amount that you can have in a category, but right now it's unknown.
Right.
But part or all of your retirement assets, which is, let's face it, it's people's biggest chunk of money typically, into something that I would argue isn't an investment, but it's speculation, right? It's I don't want to get into
it's a speculative asset class. I mean, that's fair to say.
But it's an asset class that behind it doesn't have an entity that creates something.
Yeah, that's true of commodities too, and there are commodity funds in. I'm giving you a hard time here.
No, I think it's a good debate. With a commodity, at the end of behind the commodity is a barrel of oil, or a bucket of beans, or some bacon strips, right?
Yeah.
Whatever it is, but what is redeemable behind Bitcoin other than people want it?
Perception. So what's the value of a hunk of metal other than a perception of value from other buyers? That's essentially the same argument for a cryptocurrency. It is a perception of store of value because other people are willing to deem it to have that value. No?
I don't disagree, but the definition is overly broad. If I was in court, I'd say the argument's overly broad, right? Because a piece of metal I can sell to someone who would need metal, It has a industry. It has a history of being used in the construction trade or the building of a car, whatever type of metal we're talking about.
Let's say gold in my example here. You could say gold.
Gold is used in manufacturing of certain jewelry. Obviously, it's used.
But but it's ultimately there's a perception of value.
Gold is probably the better example in the way my brain works, right?
Yeah.
So I guess you
not
can
that,
add.
Not that we want to get too far down the crypto, merits or
right.
lack of merits. I mean, I think that it's simply that let's even back it up from your concern about what is it really, that kind of thing. But let's just for the moment presume that there is retained perception of value.
Sure.
But for a consumer in a retirement plan, an employee, with the degree of radical fluctuation in value, which the appeal is when it goes up, but it doesn't always, we'd have periods where it goes down dramatically. And will it retain this perceived value, right? Is maybe the question, right? Okay, it's had an astronomical rise in assumed value because there's all this attention to it. But what if everyone decides it's not appealing anymore? To your point, what if they just say no? There's another alternative that we're going to choose instead, or Bitcoin's made all their coins now. That's not the case today, but someday, right? And people say, yeah, but I really like Ethereum better anyway. Just so Bitcoin's value changes, or fill in the blank, right? We don't know what the future holds. So I guess my point is that's a challenge that this approach faces is the fluctuation in value is dramatic. When it comes to private equity or private credit, there is a different set of concerns about the frequency of valuations of those assets. And so it's again, what is truly the value I'm either buying or selling for when I want to get out of those assets. And these are large, will likely be, volatile based on accessibility and various concerns like that. I think there's some challenges for sure.
Yeah, well, at least with cryptocurrency, there's a public market for it, so you can see the value as determined by the number of buyers and sellers, and it is generally considered liquid, certainly volatile, but liquid. And your point is very well taken about private credit. If there's no independent setting of what the value at the end of any day or any month is, it's just if you want to make it's not liquid, meaning immediately, and if you want to sell it, it's only worth what some buyer that you can find somehow who might want that.
So sorry, you were about to say something. I just want to give a little background. Private credit, private equity, what are these things essentially?
Fair enough. Yeah.
When we talk about stocks, we talk about stocks that trade on an exchange. That's publicly accessible, publicly traded securities. Private equity is ownership in a company that is not publicly traded and therefore is not as accessible to my principal if I want to get out, or whatever the market value would be at a given time, because there is a much more narrow, limited market because it's not traded on exchange. It's more of a private transaction of sorts. So similarly with credit, the risks of private credit are harder to quantify. It's not like we have a rating service who's going to say, oh, what is the value of this bond, for example, that is a publicly traded company and a publicly available to transact on an exchange, a debt instrument. No, this is something where it's a behind the scenes private debt. It's not put out, and it's done through large buyers generally, and there can be more profitability at times, but the risks are less transparent. Okay, so I don't know if that's helpful in some of the setup to this, but it's relevant in some sense to understand because there's more risk inherent in these products or these types of asset categories because of less liquidity, less transparency, and perhaps other considerations.
Yeah. And I think coming back to the 401k, I mean, usually there's like this barrier to entry for these private credit, private equity, even cryptocurrency assets. Doesn't mean you can't go out and buy a Bitcoin ETF or something like that. But typically these investments are for accredited investors, especially talking about alternatives, and putting them into the 401k wrapper. I mean, there's a whole range of complications that could arise, and like we were talking about earlier, what could go wrong with a situation like that.
Yeah,
but I think when you open up access and people don't know, well, maybe I should probably allocate no more than 10% of my portfolio to cryptocurrency. They're seeing Bitcoin go crazy, and they have that option in their 401k. Maybe they put a lot more money than they should into a cryptocurrency. Same goes for private.
Yeah, people tend to follow where they see big returns, not thinking that the other shoe can drop on some of these things. The elephant in the room on the cryptocurrency thing isn't there some massive conflict of interest for the president to be trying to ease the way for enhancing the number of buyers of cryptocurrency when he's been moving toward this industry with creating meme coins and NFTs and all this other stuff that NFTs and cryptocurrency of his own making. The conflicts are blatant, I guess is the way I would put it.
Well, we'll have to wait and see what the Secretary of the Department of Labor comes up with. Hopefully
he doesn't mind if he loses his job, I'm sure.
Hopefully there's some to Russ's point, hopefully there's some maybe limitations in the rules about the percentage of these new assets that are going to be allowed, that we're talking about, that are allowed in any given 401k option, right?
Yeah. I think one other thing I was reading was like there doesn't seem to be a huge push to have private equity, private credit in 401k plans from the get-go from anyone other than the asset managers that run these private credit products, who have saturated their market a little bit with the endowments and the large institutional funds.
But you do make a point though that I think there's been notice that certain higher tier of wealth do have access to certain these somewhat generally thought to be harder to barrier to entry, higher valuations. You need to have a certain level of wealth, a more willingness to endure illiquidity, but the performance for these characteristics have been at times significantly advantageous. We haven't, when we've looked at private credit, we haven't said, oh, this is really compelling. But maybe there are times when people do. We just, as we've been looking at it and what's available in our universe, haven't seen things that we say, oh, I can't wait to get that. But for at least for our clientele who are retirees and oftentimes value liquidity, or some measure of marketability, but I think private equity, we've seen some pretty big opportunities for performance from that. But will that translate when it's available to the masses? When we see things happen, when they get available in funds or these kind of things, we see the characteristics change, right? Something that is generally illiquid but becomes available on a fund has greater liquidity and ends up being transacted more readily when there are downturns. What had held up as an asset class because of its nature of maybe a little less transparent, a little infrequent valuations and so forth, some of these characteristics are very likely to change as there's greater access to these investment categories.
Well, I think, right now, as you've said, that I think Russ said it about being an accredited investor, meaning have a certain level of wealth and risk tolerance, et cetera, before you're allowed to make certain types of investments. The issue with 401k, and it's not a new issue because of this executive order, but these new products create an enhanced issue, and that is how much does the consumer know? So if you get a menu of mutual funds or ETFs or target funds as your option at a 401k, although many people don't do the research, they pick one or listen to hopefully their financial advisor, hopefully not their neighbor, but um, nothing wrong with having a financial advisor as your neighbor. If that's how you heard that. Um, but they have the opportunity to do the research. They can look at Morningstar. They can look at other rating services for different types of assets. They look at the historical performance of a given mutual fund, for example, and they can make a judgment. An accredited investor for private equity or cryptocurrency maybe don't have those tools either, but they are more sophisticated, experienced, and more likely than not is working with someone to buy these things.
Yeah.
So if you're that new employee and you're coming in or you change jobs and you're looking at your 401k, I don't know how you evaluate private credit. There's not a rating service or a history of such, or if you want to research it, I don't know what the opportunity to do so would
That's a
be.
good point. What if the way this is implemented, though, pose an inquiry here. What if this is implemented in a way where we've heard Edelman say, Rick Edelman say that, 1%, what's 1% going to do for, if it goes badly, but if it goes well, it could have some material benefit. What if we saw some sort of managed approach to say it's only available in target date funds? You could have, a 5% weight to these various illiquid categories that's done through some manner of target date fund or something like that. Would that cause you to be more attracted to the idea that these things maybe would be more appealing to be accessible through a retirement plan?
Yes.
Yeah.
The short
I think
answer.
so too.
Yeah.
I think I'd be like, all right, if there was some, you couldn't, go off the deep end. And now it's funny because, shouldn't we be thinking, well, you're responsible for your own, resources, your wealth. You're an adult.
That's right.
Do as you want. At the same time, we know that oftentimes people make decisions just from years of experience, having seen this, that it's not always based on a thoughtful review. It's based on, oh, look at the performance on that. And, when they look at their statements of what are the options available, and they go, I'll take that.
Absolutely right.
Well, I want that rate of return,
Right.
which has already happened, instead of that rate of return. That kind of thing. So there's this attraction to selection by past performance.
That's right. And if Bitcoin, holds up for the rest of this year or another cryptocurrency, however you want to frame it, it's been a good year. So, that employee next January looking at past returns says, 40% return.
Yeah.
Yeah.
Give me that.
And there's no additional information other than a disclosure about risk, I guess, maybe, right?
Yeah,
but
right.
There's no other substantive information about who's the manager and what's their 10-year track record and so forth. So I don't know. This looked like a solution to a problem that didn't exist.
A problem. Yeah.
Yeah. And your point earlier, Chris, about the President Trump and his crypto, he campaigned on being the crypto president, and he's got his fingers in a lot of different pots of that. So I'm not surprised that this happened.
No, I agree. It's certainly in keeping with what he's talked about. I agree. At the same time, there's an inherent. This is a topic for another show, but I think there's an inherent problem when a president sets up a structure to benefit from things he can control through regulatory fiat or whatever.
There is an inherent problem in Washington, D.C. related to insider trading.
That's a good point too with Congress as well. Yeah.
I mean, with all the stories that we've, half joked, but there's some seemingly statistical truth to it that Nancy Pelosi is the most successful stock trader, and she beats Warren Buffett. I've been seeing memes about Warren Buffett calling Nancy Pelosi for advice. And I don't know. Obviously, we don't know. But there's so many examples that there needs to be some significant reform between the executive branch. Arguably, the judicial branch. Has been stories about potential conflicts of interest, and the legislative branch. Right. So all of it in Washington, D.C. needs some real ethics reform.
No, that's a fair point, Jeff. That's a fair point. It's not isolated to any one individual or one branch as it relates to this.
The problem with the ethics reform,
but it doesn't make it acceptable either, right?
It does not make it acceptable, and I would argue that the voters don't seem to care because it's never an issue that comes up in campaigns that people that really are concerned about.
Yeah. Oh, that's bothersome. But here's the takeaway for our listeners.
Right.
When it comes to this possible change in direction when it comes to your 401k plan, the accessibility of these somewhat historically illiquid asset classes or asset classes that haven't been as mainstream. Be careful. That's the bottom line. If you include a modest measure of something like private equity, private credit, cryptocurrency, etc., real estate, and so forth, these are things that it's reasonable to a point if you want to take more risk, but recognize you're taking more risk when you incorporate some of these categories, and you want to do that kind of thing, I guess at different stages of your, time horizon, maybe differently, but you want to do it in a measured way is ultimately where I'm going with this. Be careful and don't rush head first. People listening to this program and programs like it probably already are inclined to be that way anyway, where they might be interested and they might take some interest in some percentage, but they're likely to know enough to think, I'm not going to go off the deep end with something that's high risk, speculative risk.
And I'll add one thing to that, if you don't mind, Chris.
Please.
We see so many individuals, with their financial plan, and they have for the money that we manage and things that we do for them, it's very thought out, very comprehensive, very detailed. But even those people who are very detailed about part of their financial plan, when they switch jobs, many of them don't call their advisor, call us and say, I have this 401k or I'm starting this job. What do you suggest that I pick as an option? Some do.
Yeah.
But it's a missing piece of people's financial planning. And it ultimately is, one of the most important ways to grow wealth.
That's a great point. And a related part of that conversation is, how much of my contribution should be traditional? Should I do some that's Roth? How much? How much can I afford? What percentage should I do? All these kind of things that we, you kind of go in, as you've said, just you kind of fill out some paperwork and you're like, okay. And then you don't always think about it for a while, sometimes ever,
Yep.
So these are things worth talking about. And if you need a little counsel, talk to your financial advisor. If you don't have a financial advisor, come see us. We're happy to work with you. So thanks for being with us today. And until next time, keep striving for something more.
Thank you for listening to Something More with Chris Boyd. Call us for help, whether it's for financial planning or portfolio management, insurance concerns, or those quality of life issues that make the money matters matter. Whatever's on your mind, visit us at somethingmorewithchrisboyd.com or call us toll-free at 866-771-8901. Or send us your questions to amr-info@wealthenhancement.com. You're listening to Something More with Chris Boyd Financial Talk Show. Wealth Enhancement Advisory Services and J. Christopher Boyd provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is general financial comments and cannot be relied upon as pertaining to your specific situation. Wealth Enhancement Group cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.